Hi everyone and welcome to Big L's Investing, and in this video I'm going to be talking about JP Morgan and Morgan Stanley. But before I get into that, I want to start off by saying that this video is for entertainment purposes only, and please make sure to do your own due diligence prior to making any investment. Now that that's being said, let's get into the video. Okay guys, so JP Morgan and Morgan Stanley report second quarter financial results before market open Thursday that were well below analyst expectations. JP stock dropped nearly 5% after the opening bell, and Morgan Stanley shares fell more than 2.5%. JP Morgan earnings per share fell 27% over the year to $2.76, while revenue was relatively flat at $30.7 billion. Wall Street analysts were expecting earnings to fall to $2.92 per share from last year's period of $3.78. JP Morgan really missed revenue estimates, which were forecast to increase 4.3% to $31.81 billion. The bank is planning to suspend its share buyback program following these results. See, these numbers to me come in as a real shock, because yes, I expected them to report misses, but I didn't expect them to report 27% below what analysts was expecting type of misses. And that's due to the fact with the Fed raising the rates, you would think that this would benefit the banks, but it seems that it's not doing the job. So this is really shocking to me. Like I say, I'm not really shocked about the fact that they've reported misses, because there's a lot more macroeconomical events going on around the world, and it's not just the rising of interest rates. However, you would have thought with the high interest rates that the banks would have started to level out a little bit, but that doesn't seem to be the case, because they reported worse earnings than I was expecting. It goes on to say, the US economy continues to grow, and both the job market and consumer spending and their ability to spend remain healthy, CEO Jamie Dimon said in the announcement. But he says high inflation, weakening consumer confidence, high interest rates, never seen before quantitative tightening, and international conflicts will likely have negative consequences on the global economy down the road. JP Morgan's gross investment banking revenue fell 32% to $788 million. Provisions for credit losses increased to $1.1 billion, which included $428 million for the reserve build and $657 million of net charge-offs. Wow. As a result of JP Morgan's recent stress test, the bank will build capital and focus on managing its capital ratios, Dimon said in the announcement. In order to quickly meet the higher requirements, we have temporarily suspended share buybacks, which will allow us to maximize flexibility to best serve our customers, clients and community through a broad range of economic environments. Morgan Stanley earnings fell to $1.39 per share, down 25% from the $1.85 reported for the period in 2021. Revenue declined 11% to $13.1 billion over the year. Analysts were expecting earnings per share to fall to $1.57 on revenues of $13.4 billion. In quotes, overall the firm delivered a solid quarter in what was a more volatile market environment than what we have seen for some time. CEO James Gorman said in the announcement. Morgan Stanley's equity and fixed income was able to partially counter weaker investment banking activities, he said. Morgan Stanley investment banking revenue fell to $1.2 billion, down 55% over the year from $2.5 billion. This is crazy. Now if we look at both banks, in the year to date you have JP Morgan that is down 37.56% and Morgan Stanley which is down 32.46%. This is absolutely crazy. To me, in my opinion, this is an absolutely great time to get into these stocks. I might actually start buying some JP Morgan myself, because JP Morgan out of the two is my favourite. And it's good to know that both of them pay a very good dividend as well. JP Morgan pay a 3.71% dividend and Morgan Stanley pay a 3.83% dividend. So this is definitely something to think about. I think now we are being given a great opportunity to get a company that will do decent growth over the next few years when the macroeconomical events are finished, but also provide a very good dividend. So this is something for us to think about. Okay, so that's it for the video. I hope you liked it. If you did, please like, subscribe, and I'll be back very soon. Take care.